Gold is hitting absolute record highs right now, right? And yet, the world's biggest gold miner is currently wrestling with falling production. It's kind of this fascinating paradox. So in this explainer, we're going to unpack the raw data, some massive billion-dollar deals, and the real financial picture of Newmont Mining to find out what's actually going on beneath the surface.
Which brings us to the ultimate question we have to answer today. Is this stock a golden opportunity or just a value trap? Newmont literally just settled a massive joint venture dispute, but at the exact same time, they've posted these highly mixed earnings that have Wall Street totally scratching its head. So what do we make of all these conflicting signals?
Okay, let's dive into this. Here is our roadmap for today. We're covering 1. The billion-dollar handshake. 2. The financial reality check. 3. The bull versus bear debate. 4. Major investment risks. And finally, Section 5, our final verdict.
Section 1. The billion-dollar handshake. The Barrick Nevada Gold Mines deal.
Look, this deal is a huge catalyst. It effectively ends years of intense, honestly pretty bitter legal fighting between Newmont and Barrick over their operations in Nevada. To finally forge this lasting peace, Newmont is handing over $1.95 billion in cold, hard cash, along with the Fiberline and Mike projects. And in exchange, Barrick brings the 4 Mile project to the table. And that is a huge get, because 4 Mile is one of the highest-grade undeveloped gold deposits in all of North America.
So, no surprise, Wall Street absolutely ate this up, sending the stock up over 5% right on the news. Why? Well, it instantly removes a massive operational distraction. Plus, it paves the way for Barrick's planned North American IPO. But the absolute biggest win for Newmont here is that they finally have a partner with real skin in the game on 4 Mile. That means they can share those hefty development costs and seriously mitigate their risk.
Section 2. The financial reality check. Unpacking Q2 2026 earnings.
Now, these Q2 numbers, they were definitely a mixed bag. They beat expectations on earnings per share at $2.10, but they slightly missed on the top line with $6.2 billion in revenue. But what's really interesting about this is the jaw-dropping metric right here. $2.2 billion in free cash flow. That is a company record. And they didn't just hoard it either. They returned nearly $1.9 billion directly to shareholders. It just proves this company is an absolute cash-generating machine when gold prices actually cooperate.
And to double down on that momentum, management just authorized a staggering $6 billion share repurchase program. $6 billion! Make no mistake, buybacks of this magnitude are the ultimate signal of executive confidence. They are basically screaming to the market that they believe their own stock is deeply undervalued.
But here is where we hit a pretty sobering reality check. Despite all that great cash generation right now, management's own guidance for 2026 shows production actually dropping to 5.3 million ounces. Guys, that is a full 10% drop from 2025. In fact, the executives are openly referring to 2026 as a trough year for production.
And it gets trickier, because as production shrinks, the cost of doing business is inflating. Their all-in sustaining costs, or AISC, have jumped up to $1,680 per ounce. This is largely driven by higher energy prices and lower ore grades. It perfectly illustrates the painful paradox Newmont is trapped in right now. They are pulling less gold out of the ground, but they're paying a massive premium to do it.
Section 3. The bull versus bear debate. Wall Street versus Morningstar.
So, right now, the broader market consensus sits at a moderate buy, with an average price target of around $133. But if you look closely, expert opinions are fiercely divided. You've got Wall Street bulls charging ahead. CIBC is targeting $170, with Scotiabank and Bank of America right behind them. But then you look at Morningstar. They are sitting all the way down at $67, arguing the stock is wildly overvalued. It is incredibly rare to see a solid $100 gap between major analytical firms on a blue-chip stock like this. And this brilliantly illustrates the tug-of-war happening between two totally different narratives. The bulls, they're fixated on the Barrick deal, the massive buybacks, and these record-high macro gold prices. They just see an unstoppable cash machine. But the bears are laser-focused on operational reality. They see the rising costs, the falling production, and honestly, a pretty weak 1.1% dividend yield that just isn't going to turn the heads of serious income investors. Look, if you think gold stays above $4,500 an ounce indefinitely, Newmont offers incredible upside leverage. But if not, the bears have a very sharp point.
Section 4. 3 major investment risks. Navigating the danger zones.
Now, If you are a risk-averse investor, there are 3 specific headwinds you need to watch that could completely destroy this bullish thesis. First up, energy costs. Higher oil and electricity prices are heavily squeezing their margins, and if they stay elevated, those all-in sustaining costs could easily push toward $1,800 an ounce. Second is execution risk. Newmont is navigating a super complex turnaround with a brand new CFO and COO, and trying to turn around physical production while reining in costs? That is notoriously difficult. Finally, gold volatility. Their operations rely heavily on macro factors that are completely out of management's control. If the Fed hikes rates, gold prices could pull back, and pull back hard.
It's not all doom and gloom on the risk horizon, though. A massive silver lining here is their Red Chris Block Cave project up in British Columbia. They actually just got regulatory approval for that to begin in 2027, so that provides a very real, tangible, long-term growth driver for the company's future output.
Section 5, Final Verdict. Buy, hold, or sell.
So, the crucial point is, what does this all mean for you? How do you map this conflicting data to your own personal strategy? Well, let's break it down based on what kind of market participant you are. If you're a long-term investor looking for gold exposure, Newmont is a solid hold right now. There's real upside there, but honestly, only if the new management team can successfully control their costs. However, if you're a short-term trader, the dynamic totally flips. The stock recently hit a 52-week high, which makes this an excellent moment to consider taking some profits off the table.
And for those of you sitting on the sidelines looking to maybe build a brand new position, patience is going to be your best friend. Based on the operational headwinds and that 2026 trough year we just talked about, the smartest action step is probably to wait for a pullback to that 120 to 125 range. You really want to make sure you have a built-in margin of safety before jumping into a trough production year.
Regardless of your timeline, though, you want to keep your eyes glued to 2 ongoing metrics. First, obviously, watch the next major macro move in gold prices, but second, and honestly, maybe more importantly, closely monitor Newmont's monthly production reports. That data is exactly what's going to tell us if management's predicted trough is finally stabilizing or if it's actively getting deeper.
We've laid out the billion-dollar catalysts, the crazy cash flow records, and the rising costs. Now it's your turn to weigh the scales. Based on the evidence in this explainer, are you buying Newmont at these levels? Thanks for joining me on this deep dive into the data. And as always, keep exploring the numbers.